Welcome, guys, to my first 100 episode. And in today's episode, I want to do something different. I'm not going to do a weekly update. Probably later in the week, I do one for a short one podcast. But today, I really want to go back to the past 9 months and review some of the big ups and downs of some of the shares and crosses and indices that I traded, and what lessons we can learn from that. Last 9 months has been really fantastic journey for both traders in many different styles, and I just want to go through what I have learned and what gain I've got from the last 9 months. Coming up next. Okay, before I start, I want you to set your mind back to the early part of 2020. Initially, we have U.S. sending a rocket and killed some Iraqi general and Iranian general on Iraq, and all sort of things happening over there. And we then have obviously over in Asia the outbreak of the COVID-19, but it hasn't reached Europe yet, and the Western world, including America, Europe, UK, and so forth, all very much, in my view, in retrospective, has been quite, hang back, not taking it very seriously. But the Asians very different because they have gone through 2003 with the SARS virus, and how this have upset the local economy. So they took it very, very seriously. I think the most serious one, apart from China, is South Korea. And just think of that on its own, and let's cast back to some of the big ups and downs that I've tracked on my lots of the trades that I track over time. Okay, the first one I want to look at is Australian dollar against US dollar, and basically this is back in 2019. We of course have heard the fire in Australia, and spanning quite a lot of stuff and caused a lot of devastation. But in Australia, but the US dollar against Australian dollar against US dollar seems relatively flat. It's not doing much for the more or less for the whole year, and more like a sideways trade for mostly 2019, so to speak. But then coming into 2020. It's sort of starting to recover a little bit at the start of the year, but suddenly, of course, we have the COVID-19 coming in, and then basically Australian dollar just on this cross, Australian dollar against US dollar just continue to go down, 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 down. So basically, it means that it takes less US dollars to buy an Australian dollar, so to speak, for this cross. And from more or less January onwards. The Australian dollar is losing ground, and the more the panic comes in March, the worse it gets, and it gone down to as low as 0.56 Australian dollars against US dollar kind of thing. So 0.56 was near the low tide, I think even lower than that, 0.55 or something, and that is on the back of like I said before, the fire in Australia and the coronavirus, and shutdown in China, supply chain being upset locally and internationally as well, and of course everybody panicked. During that time, I'll probably go through some of that a bit later on. But from this cross point of view, from this forex point of view, it has been devastating. But if you're a trend follower, if you have using my system, not even a simple 200-day, 50 days moving average, crossover moving average, you have caught this move relatively early on in the year. In here, I had to specify I'm not talking about day trading, okay? I'm talking about proper long-term trading. That is a proper trend to form. It takes mostly weeks, maybe months, to actually form that, and then once it formed, the trend could last weeks and months again, probably years as well. And in this case, early on in the year, the trend started established, and my short-term, medium-term, long-term system basically all gone bananas, so to speak, in reverse from early in the year, and then it's just really continue keeping shorting. Shorting is the name of the game, so to speak, of this cross, and it just continue going down, and for the first 3 months up to near end of March, early April time, is more or less is a one-way street goes shorting this cross, and some up and downs in the 2 ATR system, but mostly caught a lot of the down moves. And if you have to use the turtle system too, which is covered in the Turtle Traders by Michael Covel, you can just use that, and you have caught quite a good chunk of this trade as well. And of course, the 20-day move, 50-day moving average one has also caught a lot of that too. But basically, overall, if you learn to short particular shares or cross or commodity or stuff, you have make money. That's the first thing. Well, there's a couple of things you can learn from here. First of all, always stick with your system. Black Swan event. Secondly, Black Swan event happens every so often, and a lot of time when Black Swan event happens, it's out of the blue, out of the whack. You don't even know about it. There might be people who in the financial industry who knows, but a lot of times most people don't. And for a retail trader, you and I, it is always after the fact you understand what might have happened. But the market's always somehow telling us something, and your system is there to help you to decipher what the market is telling you, what that something is. And if you don't stick with your system, then too bad. There is people who use the hunches. There's people using how they feel. I mean, those people, a lot of people also have experienced people I'm talking about here. Through their experience, they see certain patterns happen. Their mind works very quickly. Like Jesse Livermore, they have then become some sort of sixth sense and give them a hunch. But for us, mostly the uninitiated, so to speak, the new people who just want to learn trend following, you should always stick with the system until you are really good at what you're doing. Then your brain somehow give you some signal, but it doesn't stop you. Doesn't mean that you don't follow your system. You still follow the system, but the patterns, whatever hunch you have from your brain, you can still use it. That is not a problem, but you always stick with the actual trend following system to give you the ups and downs and which way to go with the market, so to speak. And also in here, in this one particular one, one thing that jumped out quite a lot is to even if you buy short just one lot of Australian dollar against USD, you make quite good money on here. But also if you have actually have a method, a pyramiding, and then you can actually earn a lot more. So again, that pyramiding method I use is from Turtle Traders, and just look at the company Turtle Traders from Michael Covel, and I think it's chapter 5. It talks a lot about that one. So go and check it out. But overall, what I'm trying to say here is, the Black Swan event happens every so often, and even though we have a rocket attack from America to in Iraq to kill some Iranian general and stuff, the market didn't really move much. Maybe they just sort of get used to Middle East kind of ups and downs, and America always try to move things around in there, influence things. But then the COVID-19 comes in when the West basically didn't prepare at all, and then you actually see big drops in a lot of shares, commodities, index, and you name it. Mostly, I think all of them are affected, and in this case, in Australia, affected quite a lot as well. So here you can actually, for the first 3 months of the year, more or less from February, you can make quite a bit of money out of just shorting this cross Australian dollar against US dollar here, and overall, I think it's worthwhile to study this. I mean, on that little bit. Secondly, then of course we have from March, end of March, early April onwards, the Feds in America, as well as the financial institution, authorities around the world following what the Feds does, and just pumping loads of money into the market, and that money have to go somewhere. That wall of cash have to go somewhere, and just like 2008, 2009, when the Fed pump loads of money into the financial system, we have a long bull market, and in this case, this sudden wall of money, more or less, I think like $2 trillion US, that come in at the end of March, early April time, and just changes everything. It just stopped the rot, so to speak. And from I think end of March, Australian dollar against US dollar sort of gone up. So basically, it just means that there's so much US dollar running around out there, and just weakens the US dollar, and then just reverses the trade. And so Australian dollar become more expensive, so to speak, not because Australian economy is doing any better than anybody else, but it's all because US dollars got so much weaker because of the extra money that's being pumped from around the world, so to speak. And of course, there's a lot more US dollars than other nationals currencies running around. So and most things are traded in US dollars terms, so to speak, and commodities, metals, and so forth, and oil, grains, and stuff. So this one basically just turn around for this cross, and we can see the major trend changes, so to speak. The 280-hour changes first, my short-term system in late March, and then the rest basically, the changes mid-April, and then to May, June kind of time frame. And this war of money just basically continue go. And if you have keep track of my sample update on a weekly basis, you've seen from end of March to April, my recommendation for this cross has been buy for short term, and then slowly medium and long term system also turn to buy as well. And only recently, early September, the change sign. So in fact, I think I talked about this in one of my episodes. It's up from April onwards until September. We got like 5 months or so of a trend that's been moved, gone up so much because of extra money, so to speak, in my view, coming into the financial market. And this cross just continue to gain and continue to move higher and higher. So the US dollar continue to weaken, so to speak, in that sense, and that just for you to judge for yourself. But if you look at the graph yourself, I personally use something called ShareScope in UK. I use the basic package ShareScope Gold, and I found that's good enough for me for the money's asked for. And I just look at the chart every day on that one. And for me, as far as I'm concerned, this 4 months from April to September, if anybody has some sort of like a trend following system, will have make quite a lot of money out of that. That's just my view as well, okay? And this also talked about the nature of trend following. You need to be prepared. Sometimes trend can last much longer than you expect, because at the end of the day, we are trading, not, in my view, if you think of it deeply, it's not just a stock or commodity or whatever market you're trading. We are trading the people who are trading those market, the emotional thinking, the greed, the fear, okay? And when you talk about greed and fear, links hand in hand with black swan. When sudden things happen, perhaps I say an earthquake and hurt some oil refinery, oil would just like gone shoot through the roof. Everybody just worried there's no oil or something. So suddenly we have COVID-19. It's upsetting the world globalized economy and the trades around the countries, and how people, the Feds comes in, suddenly comes in and flood the market with lots of money, how everybody panic and say that that's the end of the world, a lot of business have to close, so to speak, and so forth. And those extremes of greed and emotional feeling pushes the market to the extremes. So I think in one of my episodes also talk about you need to look at standard deviation curve yourself, okay? It's more like, trend following. The things I like about it is, if you look at like a top hat, okay? The edges on the right-hand side, left-hand side. The right-hand side is your maximum. If you think of it, that is your extreme event for positive result that go for your trade, so to speak, when the trade is actually going. The left-hand side of the bull hat is trade that's go against you. If you cut short of those extreme event that causes you to lose lots of money, then your account is safer in the sense that you can keep a lot more of your money, your hard-earned money or whatever trade money, so to speak. And in this instance, because you limited the downside, but on the reverse you don't limit your upside. you basically gain a lot more over time, and that's the nature of the trend following. It takes times to build the trend, and when the trend set up, you should just be patient and wait for the trend to complete itself. So you have to be patient in both ways: patient for the trend to come to set up itself, also patient for the trend to actually play it out. And so this one, another thing that you need to learn about trend following, it's not for people who just want to day trade. You can day trade, 200 sample lots, whatever, so 5-minute charts, whatever. But that means you're more like only picking a little bit of money off the table, so to speak, when there's loads more on the table, because the trend is continuing going in your favor. Sometimes it could happen, and that is the type of thing that you need to watch out for. And so in this one, the trend is 4 months, let's say. So you make quite a bit of money, and your pyramid again, when your pyramid down, when the market is going down, pyramid down with the market, so you sell even lower at lower prices, and when the signal reverse, you close everything, and then in late March, early April, you reverse your position and slowly add more onto your position, and then you period up to 4 pyramid trade plus your original trade, so total of 5 lots. You have earned quite a lot of money basically just sitting on your ass when everybody out there is firefighting, so to speak. And this is just one way to make money, and to me this fit me, because it fit my my work, so to speak. Like a lot of people, I work 9 to 5, and most of the time, up to 6 or 7 o'clock, I really don't have time to sit down in front of a screen to look at things during the daytime, or 11 o'clock at night, spend half an hour here and there just trade when everybody else already shut down in Europe, and just trade the Hong Kong market or Australian market kind of thing. I just don't have the time, and I'll be very tired anyway for next day, ready for work, and over the weekend as relax time and spend time with children. But that doesn't mean I cannot trade. So in that sense, I need to take a long-term view. So in that sense, I think you need to read the book called How I Make $2 Million from the Stock Market, and Nicholas Davis. It's a very similar situation. He's busy doing lots of things, dancing around the world, but he can still make money that way. And I take inspiration from there that I can still make money if I find I set up a system that I can stick with that fit my lifestyle, so to speak. And this is something that you need to think about. Do you want something? I mean, you need to find something that fit your lifestyle, however your lifestyle is. Okay, if you're busy and you don't have time to look at the screen all the time, I think trend following or more long-term based trading will be much nicer, more efficient for you. So for this one, Australian dollars against US dollars, basically, if you have stick around with it, this one can make you lots of money. Even for me, I was just trading for a simple one trade from the basic from end of end of March and until early September. Just one trade. And do you know how much I bet on? I mean, this in UK, I'm doing spread betting as well, okay? On this cross, I only bet like 10p per point, okay? And overall he's about 1,000 points over this 5 months or so, 4 months or so. And it basically, let me for 1,000 quid just on that one, okay? I have also other account to make even higher, make higher money, but like say even the basic, if you just keep your size low and let the trend when the winner runs, let it runs. Sometimes you'll be surprised how much money you actually can gain from here. And plus pyramiding, you might basically one trade is 1,000 and the other one is 7,000 and 6,000, 2,000, 200 something like that. So overall it's about 2,000 quid. So first one earn about like 1,000 and the other one is 700-800 pounds, and then 600 and 200 something, and then that overall just making just over 2,000 for me. So which is good, and that's the power of long-term trading plus trend following and pyramiding, which is something that you need to add. So that is update for this particular cross. Okay, next I want to talk about is gold. And this year, basically, gold, at the start of the year, I was sort of, in a way, I through some other means of following the market, so to speak. I believe gold should go up this year and also next year as well. And so I sort of start watching it at the end of last year already. So from basically from end of last year, so to speak, if you actually look into it, and it sort of move slowly. Sort of like it's been in a journey since 2018, 2019 that the gold has slowly moving up, but not very significant big move on a month by month, week by week basis, but over the years, last couple of years, then you have been trading gold, you have made some money, but gold has, just like silver, has been very jittery. If you use a short-term system like the one I used, the 2 ATR system, you didn't make much money. Even the turtle system, just about average. But if you actually use the long-term system, in this case 200 days over 200-day moving average crossover, you can have actually make a lot more money out that way. It shows one reason why I have 3 systems, because for a very volatile market that moves up and downs all over the place, sometimes it's difficult to make money just using a short-term system out there, because you get in and out so quickly, and the market moves up and down so much that you basically you lose quite a bit. So a medium to long-term system for a volatile environment, in my view, is a better way to trade. So in gold, basically, last couple of years I've been looking at it anyway, but just end of last year really looking at thinking, it's time to go back in gold. I've been basically on ever since, so to speak. And so gold for this year, the start of the year, we have this little hiccup. Suddenly moved up to, I think, above. It was struggling to go above 14,000 for quite a while, that kind of thing, and then suddenly, and we have the early in the year, we just have America sent the bomb to Iraq, kill some Iranian general, and then both oil and gold, silver sort of shot up a bit, and then it just shot up above the 14,000, 15,000 area. And basically we have quite a bit of a good run, so to speak, but it's very jittery, just up and down, up and down. So for all of these years, it's very much very volatile. Short-term trading to our TDR system actually works, makes some money, but get in and out to a lot. That means what we call in industry, what we call it whipsaw. Basically, get shaken out, shaken back in, out, in, out. So my 2 ATR system is always in the market system, so it's either long or short. It never get out. Unlike the 200 days, 50 days over 200 days moving average. And also the turtle systems is only, if 55 days breakout happens, then you only go in, otherwise you just wait on the sideline. So to speak. So this one, it did make money, but it has been difficult for this market. But it's short-term wise has been relatively okay. Not as good as I would expect. Medium term is much better. Long-term is definitely much safer. But the gain, of course, is not as could be not as much as certain times, but sometimes be really good. So far this year, for all of this year, it's not even COVID-19 thing. We see the whole market as a whole has gained quite a lot. Yes, in March when February, so to speak, and March, a lot of jittery when the COVID-19 raised its ugly head in Europe and the West, and causes gold drop down. In March, end of March, everything gone down. Remember those 2,000, almost 3,000 daily dropped in Dow Jones in America. Really scary, and people really were panicking. They were even sending gold, just basically selling the gold, and it really got down quite a lot. So gold went back down to like around the 1,500 mark, so to speak, and then it just started to recover. And this wall of money from the Fed that I talked about earlier, and just continue, just pump the money in, and go sort of not reacting as a straight line, so to speak, sort of gone up a bit and go sideways for a while, then got a little bit sideways and it's gone up a little bit. You have a chart to actually look into the gold trade, daily chart I'm using, okay, and then you have a look. It's quite, you definitely can make money out of it, and for me basically, this one shows a lot of the power of using a long-term system, like the 250 day over 200 days. You have less of this whipsaw in and out of the market, and you don't have to actually look at the market too often with using that, and you still manage to make money, so to speak, when everybody else, especially news and stuff, say how gold are. People seems to, unless you're a gold bug, only really listen to like Sunday more gold news, related news coming out this year, so to speak, and all talk about go, this and that. But if you're a long-term trader, if you actually trade gold, you see basically, this year is a bit better, but it has been, the pattern itself has been happening in the last couple of years, but then nobody really talk about much. I mean, in essence, I mean, the lows came in 2015, 2016, and then it got sideways for 2, 3 years, and then like middle of 2018 is the latest up move, so to speak. So the up move is not just this year that happened, over the last couple of years already, and basically this year basically just accelerate. I think there's probably a bit more coming in next year, but who knows? Just my own internal analysis. But I think this one shows that when the trend is moving up, you just follow when the trend moving down, you just follow where the market is. And even though, however jittery it is with the 2 8 hour system, so long you stick with it long term. I don't mean 5 minutes chart or 1 hour chart, that kind of thing. I'm talking about daily charts, and you stick with it thin and out for months and years and weeks. So I think, well, I'll probably say years. Okay, you earn the money, because if you do analysis yourself, you go back and look at the chart, whatever year time frame you look at. Okay, so I'd always take a long term review, so I always take the daily chart and look at like at least 5 years chart, that kind of thing. That's minimum for me. And you look at it every year. You just manually just look at ups and downs using your own trading system for the past, go through the last 5 years, and then ask yourself, do you make money in that market using a particular system manually using your hand? Okay, that's in retrospective. Behind the fact, you already seen the price move, and you're just basically tracking using your pen and paper, and just write down where you will buy, where you have sold, and then add them all overall and add up, and you'll see that the good and bad and ugly of the 3 different systems or whatever system you have. And if you trade long term using a trend follower system, most years you should make money. Sometimes maybe very little, sometimes could be quite a lot. When I say little, it could be a couple of percentage points, a lot maybe 50-60%, something like that. And also you have some down as well. That depends whether how your risk management is. But on paper, if you stick to no more than 1% trade at account, that kind of things, and you shouldn't lose more than risk more than 5% for each trade, probably about 4% or something, then you'll be okay. But overall, on the paper, it shows a couple of things. That first of all, it shows you how good your system is, and you actually make money or not. If it's on paper, it doesn't really work. I don't think you should trade it. It's okay sometime 1 or maybe 2 years you have a down year, so to speak, when you not make money. But if you're over 5 years, turn off if your system don't make any money out of that 5 years, could it is break even, that kind of thing. There's something you need to think about how your system is. If you can't even make break even for the past 5 years, and there's no point actually using that system. That's my view. But from what I've seen in trend following, yes, sometimes you lose, sometimes you win, but overall every year you most likely end up with something positive. Sometimes you have negative from one of the market. This is why you have multiple markets. So when one market has gone down negatively for 1 year, the other market is sort of gone up. So for example, if you trade Tesla, it's gone down this year, for example, just for example, okay, for argument's sake. But Apple's gone up. If you only just trade Tesla, but Apple gone up, that sort of the downward move plus the upward move of Apple will still make you whole, so to speak, for the year. You're still positive, but yeah, you have less money because Tesla pull you down. But if you just have Tesla the whole year, you basically just have a down year, so to speak. This is why your portfolio selection is important, and don't just stick with just stock. Sometimes a trend just happens. It could be anywhere. It's true that people say, there's always a bull market somewhere, there's always a bear market somewhere, but how do you know where? That's a problem. We don't know where. It could be in US, it could be in Asia, it could be in Australia, it could be in Brazil, or Russia, or in India. How do you know where? And the main things for me is, for portfolio management, I look at it more like your own garden, in your backyard, or whatever garden lot you have, or even your plant pot or something. You plan what you want. Okay, and you watch that plant, and you where did it nurture it, change soils and look after it. If any caterpillars, whatever, flies on it that hurt its growth, you do something about it. And you always just look at that lot of plants in your back garden. You look after it, and it blooms, and you enjoy the scenery, the visual effect, the smell, that kind of thing, and the bees running around, kind of thing. And you have a nice, pleasant environment. But you always look at that lot. What I don't like initially, I was like going on everywhere, and looking also at different trades. But to me, it's detrimental to me as far as I'm concerned, because you never know where the trend comes in, where you should trade in. Rather than running around like headless chicken, go for different markets, different places. I mean, so just look at 20. That's what I'm doing. I mean, I'm looking at about 40 at the moment, and the sample portfolio got about 20 in there. And basically, I just look at a limited amount of shares, cross, indices, commodities, that kind of thing, whatever you fancy, and just stick with those. And inevitably, you'll find trend over there, and you can basically just make money out of that. You can't even make money out of that little bit. What's the point looking around for, including Hong Kong shares or China shares or Russian shares, Australian, Singapore shares? It's just too many, unless you have some big international firm with loads of money to buy computers, and one computer just run particular market or something like that. And you have all different computers running for all sorts of different markets, and yeah, you can do that. But from retail trader, for you and I, you don't need to do that. Just need to have a small little bit of portfolio that you like, that you fancy, and you can do like what Dow Jones does every year or so. Every 6 months you add one in or you remove one in, just so long as it's 20 or something that manageable by you. It could be 10, it could be 5. It's up to you how many you want. It depends up to you how many you can manage, but you can sort of like trim it to your fancy, and so to speak. And basically you look at that one and catch a trend. It's easier that way as far as I'm concerned. So I got sidetracked a little bit, but you see that from certain market, and sometimes yes, it will go down, but other market that you track also pull you up. So overall, if you have a relative size of portfolio, then it will be better in that sense, because that size will help you to weather the storm, so to speak, and you make a better money out of it that way. Okay, so gold, basically, as far as I'm concerned, this year it's continued to go up, and I think it has some good moves, from end of June, so to speak, to early August. That was quite explosive move and gone above the 2,000 marks, and then now it's just gone sideways. So I think there's still some to go. At the moment, it's the formation of the last few months is more like doing a little flag kind of thing, and it might have a chance of breaking down. But it's hovering just above the 50-day moving average at the moment for price of gold. So we just have to wait and see. Also, in this one, I basically just say is, as example, very volatile market, move up and down all the time, not as smooth as Australian against US dollar chart. But you can still make money out of it that way, but then the 280 system will probably make you go in and out your trade, and then the 50 days to over 200 days moving average is much more suitable for this one. And the 280 the system 2 turtle trading system 2 system, which is something in between. But the other thing worth talk about is this 280 system here, this whipsaw in and out, ups and down. For trend follower, you need to be careful. One thing, you need to trade in relativity size. That's not just about risk management on money term, but also risk management on your mental term. This ups and down really does bothering to your brain, so to speak. Okay, it's not good that you lose money. Okay, mentally we all have ego. We all have to manage our own feeling of ups and downs. And when you lose money, you always blame yourself. Especially, I learn a lot from A students. They always think, you do certain things, it will always be right. You use certain format, certain calculation, certain activity, you always get the right result. But in trading, it's different. This is probabilities. Even 1 + 1, you think it's always be 2, no matter where you are in the world. But it could be 1 + 1 it turn out to be 11. Or 1 + 1 turn out to be -11. How do you know? And it's a probability here. So I think this really do people's heads in. And because we don't know what the next trade outcome will be, so you have to mentally make sure that you're okay with losing that initial amount of money. And using parroting is the best way, in my view, because your initial amount to go into market, you never know if that trade will turn out to be fantastic trade or not, and you only add more, and you actually think and see evidence on the market to tell you, oh, the trade is moving in the right direction, it's making you money, and so forth. You then basically continue to go up that way. And that sense, that's fine. Okay, and that also help you to build your mental, toughness, so to speak, that you know is going the right direction. But when the market is finding its feet, or it's very jittery, like the gold, volatile, running up and down everywhere, you need to be mentally prepared that when you lose money, not just mental money side, your mental side can handle it. Okay, that's why you risk. A lot of people talk about risk management. They forget about the risk management comes twofold: risk on the dollar money terms, as well as your mental terms. I think this is what Dan Payne talk about, your mental check account or something, your emotional check account. A lot of us don't even have one, or very small money in there, and couldn't handle it. They all just look at money because that's what the world tells us, but they do not really deep down go in to tell you how you can handle failure, so to speak. So in a sense, okay, you're losing your trade, you might relate that as a failure, but to me, I don't think so, unless you don't follow your system. You follow your system, that trade, whatever trade you take, whatever market, turn out to be a dog, and then you lose money, fair enough. That is the nature of doing business. Just like you having a fruit store, you buy orange and apples and sell it, grapefruit or pineapple. How do you know what your customer wants? Maybe that particular season, that time, people like lemon. And now your stuff sell. What happened? That's cost of building business. But you're not going to sell orange and apples and stuff because every fruit seller have those. And suddenly then you have people might come in, suddenly buy a lot of fruit salad and just want all sort of different fruits because they're having a party, a street party. How do you know? That's the nature of the business here. To trade with uncertainty, you need to be, first of all, okay with your losses. You go in with small amount of money and hope it go to the moon, and then you add more and more. But a lot of time it doesn't, and therefore you only go in incrementally. If the trade turn against you, then get out, get the hell out. Don't think about the position. Okay, don't marry the position when the system say get out. And don't worry too much about the money. It's just the cost of doing business, like your computer. You need your computer to do your business, right? Do you do your trading, right? You need internet access, right? Okay, that is fine. That's just cost of doing business. You might have a couple of internet access point. Okay, some using phones, some maybe a broadband or whatever. So just in case your internet provider, one of the main internet provider for Sam, so is your monitor. Your computer can burn down too, CPU broken, you just stopped. Or battery problem, everything just hangs. What are you going to do? You need a backup computer, right? Those are the costs of doing business. So it's the same thing when you're actually trading. You actually lose, it's fine, so long as you follow your system, you can pat yourself to the back. It takes a lot of time to actually train that mentally, okay? So that's why I say, for me anyway, especially I'm a more systematic guy, I'm engineering by so to speak, in university, I have a bachelor, BEng, or electronics engineering. So I'm a more logical kind of person. I do also software development and software design. Again, that's very logical kind of thinking. So for logical, systematic people, I think, to me, trend following system is good because it's logical and there's a method. It just follow. The problem is for a lot of us is human being like varieties. And we don't like to follow rules a lot of times. And even though the rules are there to protect you, a lot of time because we like varieties, we just like to pick our own rules. And you think we're God, especially when the rules are broken and you get a better positive result than what you initially used in the rule. You feel like you're God somehow. And that is not the best way to trade. You need to go back down to your system level and your method level and then say, did I stick with my system? If you have, even though if you lose money, fair enough. That is just a good trade. That's a trade of cost of doing business. Forget about it. Go. And in this volatile market, for example, gold, ups and down, get out. If the system say get out, then get out. If the system say reverse, then reverse. You lose money, fine. But that's just cost of doing business. You make sure that therefore you make sure when you risk your risk capital, whatever is on the table that you risk for, it's not money term. Also, you mentally can handle it. So let's say I trade spread betting. If I trade £100 a pawn, I know my head at the moment still cannot handle it. But £10 a pawn, yeah, probably okay. But initially I trade with 10p a pawn. Okay, that kind of stuff. So you slowly you mentally train yourself to it. Okay, some city trade or something. Thousands of pounds a pawn, that kind of thing, and they go in and out very quickly. But that depends on on first of all the money side, how big the the pocket is. And also the mental size can they actually handle it, but they train for years actually do that. For us retail investor, we just have to learn that slowly, step by step. So that is basically an update on gold. And for volatile system, the takeaway, so to speak, is use a more long-term system. That's the best. Okay, next I want to look at is oil, basically crude oil and Brent crude. I just look at it overall as oil market, okay? And yep, remember the oil? What happened to this year? The COVID-19, of course, is causing lots of issues. It's not helping. And then, yep, the start of the year is still sort of trading about $50, $60, that kind of area, depends on which one you actually look into. It's quite stable, so to speak. So, for example, for Brent crude be higher as well, about $65, $70 kind of thing. And then start of the year, little jittery again because of the stupid bomb from American. And sorry to all the American listeners, but then the U.S. military sent a bomb to Iraq and killed somebody in Iran, and so to speak, and all this jittery, and gold moved up a bit, and so is in this case the oil as well. So that's what's actually happening here. But in this case, the oil has jittered up a bit, and then it just come back down. It just gone down, continue down, and I think this is initially because of the COVID-19 issue. And the oil being used for transportation, so to speak, with Asia in lockdown, especially China slowly showing up. I mean, even then, from December when China first sort of from BBC News, the reports coming out from China that there's lockdown, there's a virus around, and Wuhan, the oil trade didn't move up much either, and it's still within the normal trade. Let's stick with just what you call Brent crude for now, okay? And it just continued that way to 60, 65 marks, and then you have of course the bombing. The rocket issue first thing in January, and it went up to like $70 per barrel, that kind of thing, quite quickly, and then reverses. But from then on, the basically small one-sided, the market has gone down and down and down up to March, early April time frame, so to speak. A bit jittery, and you compared both Brent crude and the WTI crude oil. WTI crude oil seems a bit better that way, but still the pattern is still the same. COVID-19 just wreak havoc to oil in general, and it just continue to go down, so to speak. So if you use a short-term system, they're a little bit jittery, but you make some money out of it. So 280 system make money out of that, and as usual, it's just so similar to what happened to to Australian dollar against US dollar, that kind of trade initially up to this a bit more prolonged. Started early as well, so basically more or less started early in 2020 this year, and then until early April, so to speak. So it's really down, and so you have make money that way. And remember the news saying there's some sort of problem with the refinery storage environment, 98% full, blah blah blah, and we have minus $37 at one point. I remember my podcast actually say something that the American government, the regulatory anyway, sorry, not the regulatory, the exchange, basically changed the rules that allowed the options to go negative, so to speak, or pricing go negative. And that's after after Saudi Arabia and Russia having a spat about reducing production of oil because the demand is low because COVID-19, trade war as well, that kind of stuff. And then Russia and Saudi Arabia couldn't kiss and make up, so to speak, or find a way forward. And basically Russia said, no, I'm not cutting. Saudi Arabia said, okay, fine, then therefore I'm going to flood the market, and I go to reduce the price of oil by half or something. So that just sent the market going down. And of course America has been, for me anyway, as far as I'm concerned, it's the oil producer of the world now. It's not just back in the 80s when the oil scarce and Saudi Arabia having a bit of issue in Middle East and the oil spike and so forth, which is in a fair sense, America is doing its right thing, trying to protect itself about the usage of oil, have its own way of trying to find oil, and to supply its own economy, which is fine, it's fair enough. But then it now have too much oil, so to speak, and it's basically driving the market. And just continue driving market, and people for some reason still thinking about Saudi Arabia or Middle East is the biggest oil producer. In my view, from my research, what showed US is the actual biggest oil producer, especially shale gas and so forth, and they are actually driving the market. And obviously, when the Middle East try to cut, Russia try to cut or not to increase, America's continue increase its oil production and flood the world, and basically just make a lot of its U.S. trading partner happy. In this case, Russia and Saudi Arabia, and then they are having an argument within themselves, and then of course Saudi Arabia just throw everything out of the water tap, so to speak, including the baby, and then basically hurts American output, American shale gas industry, American oil industry, so to speak. And COVID-19, of course, doesn't help people. We have lockdown. The lockdown not just in Asia, but also around Europe, in Australia, as well as in US. And need for oil, actually, for people to travel around is much lower. But America haven't actually closed down the production of oil. I think there's a lot of technical reason for that as well. But also a political one. But by the time that actually, shut down, because some of the companies just couldn't make money out of the oil, of the price so low, more lower than $40 or something. They just couldn't kill, and a lot of them have to shut down, so to speak. And then you have this, of course, America come down, try to help stabilize the situation by having China helping, U.S. talking to Saudi Arabia, and then China talking to Russia, try to stabilize the situation, so to speak. And oil sort of stop, is tumbling down. But remember, at that time, the fear was out there, so much fear. And I talked about this earlier in my other share things. The fears and human emotion that we're trading can go extremes, and remember, people talk about minus 37, which is actually the fact, and some commentary in America around the world actually say minus 1,000. Oh, sorry, minus 100. Sorry, my mistake. Minus 100. Can you actually say that will actually happen? At the time, anybody can be very fearful, traders in essence, and there's all sort of funny news flying around, and then all you can do is, instead of listening to the news, that's nothing about trend following. You don't care about the news. You care about what the actual trade is actually showing you. Your trade is saying, okay, this trade is working in your favor, so to speak, and so continue and work in your favor. Don't need to go do something else and listening to news, listening to what Fox News saying or CNN or whatever news you lock into. The squad boss, the talking head, so to speak, they all have their own views and versions, and then you also get your own panicky from whatever your trade is telling you, that kind of thing. So risk management is important, as well as how you handle your mental state as well. But overall, the news from the time is a lot of scaremongering if you look at after the fact, retrospect. But during the time when you're actually trading, was very different between trading on paper and actual trading. When the fear sets in, you will basically, you don't know what to do. You actually have no way of have a rational thinking. So all this efficient market theory, I mean, my daughter is going to learn economics, going to university this month. Basically tell her, just ignore efficient market theory, just don't even take it up. Challenge the professor to talk about that. Because it's showing this year, how fearful people can be because COVID-19, because of some third party talk about oil initially with Russia and Saudi Arabia, and how they affect the market, and people suddenly gone down to the price of oil gone down minus 37. People even talk about minus 100. Those kind of things. Is people really rational? You need to ask your question. It's not rational. Extreme fear, extreme black swan event, so to speak. You can just basically just think about, at that time, ask yourself, are you rational? You probably not. When you lose your job, or time of getting possibility of getting kicked out of your house, kind of thing, you won't act rationally. Or somebody hurting your family, you won't act rationally. You just gotta be the shadow of them, protect yourself. That's the type of thing you face in trading, in actual trading. So it's okay for paper trade, it's okay for simulation, but actually trading with hard-earned money, your own money, with your emotion on the line, is a very totally different kettle of fish. So for me anyway, for anybody out there, especially new to any system, so to speak, before you put your hard-earned a lot amount of money onto the line, you should spend minimum as little as you can to actually live trade on that particular method for minimum of 6 months, maybe a year, and just to see if you actually make money. If you can't make money that way, or it's very difficult, and you find yourself couldn't handle it, then at least you learn something about yourself, about how you handle your emotional side when you are losing money. Also, as well as when you're winning money, what irrational, stupid things you also do as well, over trading by over trade bigger size, and the market seems to go in your way. You think you're God, you can change the rules, and you basically continue to forget about your rules and not listening to your own rules, and you just bet bigger and bigger. The market continues telling you, you're doing right, you're doing good, and you're making lots of money, and suddenly one thing sudden event, boom, and you lose everything. It happens. All of us actually have gone through it, traders, in my view, and just something that you need to learn about it. So this actually tells you, to me anyway, I think from Bankrupt, it's just like news is crappy. You don't really listen to news. You don't need the news when you're trading a systematic trend following system, or any systematic system. In fact, that's my view anyway. And all those extreme event happens more often than you think of, and also extreme event seems to related to another one. So you have COVID-19, and you have then the slowdown of oil usage, and then you have sudden spat between two major producers in oil, and all sorts of things that happens, and sometimes extreme happens out of ordinary events happens, and you have no idea how things might turn out. So therefore, the risk management is important, but always stick with the rules. The main reason I stick with trend following is when things go bananas, when it go belly up, shit hit the fan, so to speak, I always go back to my system. I check my system to say, did I calculate correctly? Did my system give me the right result? If it has, I just continue. I count down a lot. Okay, it's still difficult to handle the losses, because you have to change sides, so to speak, quickly, because of whipsaw, so to speak, just because the market telling you. But you slowly learn to love that, and learn to think that it's okay just because of doing business, like I said earlier. But at least you have a system to fall back onto. So for a logical person, systematic person, I personally feel trend following is the best for me anyway. And I trade, on a daily chart, and I don't even look at minutes chart. I tried before, it's just really not for me. 5 minutes charts, and so I just found that trend following is trying to catch big major trend, and you have smaller time frame. All you're doing is picking a small little pieces of money, a piece of bread off the table. That's my view anyway. So rather than doing that, don't. Just have a bigger, better, track a longer term kind of trading. I think that would be the better way for most of us anyway, especially one with BC lifestyle kind of thing. So basically that's oil, and then that's first half of the year, and the second half of the year is second half of this from April to September, so to speak, is this wall of money from the Feds around the world. It just basically pushes the oil back up slowly, very, very slowly, little by little, in the background of COVID-19, slowdown in trade, hardly anybody traveling, some countries, some towns, cities, and start to, easing the lockdown, and people start coming out, and now we have the second round turning around, so to speak. But you can see that, again, this 2ATL system from this short-term system from May onwards, to early September, late August. Again, it's just continue making you money, the short-term money. And because the short-term trend is good, slowly up and down, few ticks a day or so to speak. Very boring for most people, especially those traders who just want, like volatile activities. Some people I know trade really well when the market is really volatile, but for those who do trend following, boring is good because your system basically just doing its job and you're following it, and it's supposed boring. Making money as a business is boring, and this is a business. Okay, when you do things right, you're doing here for a reason, to serve them, serve your customer, whatever market you're into. You're just repeating the same thing again and again, and then slowly you earn your money that way. So overall trend following for that from May to August, end of August, early September, that's more like 3.5 months, I would say. Short-term system, medium-term S2 systems is doing really well. For long-term system, it's just basically standing on the side because Brent crude and WTI is still failing to stay above the 200 days moving average. So on the long-term system for this particular, for oil anyway, it's not particularly good. It has caught the downtrend pretty much. You make lots of money there, but from May to September, more or less, you just stand there, you're just looking on the sideline. Nothing much you can do about it, that's your rule. But from that one, for oil, you're not making much money at all out of that. But at least you protect your money. That's another good thing about trend following or having a system. When a system say don't go into money, you don't go into don't go into market, you don't go into market, so to speak. Okay. And yes, it is very boring, but it protects your capital, and it basically helps a lot to also protect your mental capital as well. And yes, it's lack of action, and you want something to happen, but that's also time to put in your discipline in the sense that do not go into market unless your system actually tells you to. It could be boring. You could be feeling you want to do something, scratch something, do something with your fingers, click the mouse button. But when your system say don't, then don't. So a good thing about trend following is, and it actually shows you who you are. Are you a disciplined person? And to me anyway, I think trend following is good if you are a disciplined person, a logical person, and maybe have some military background or something. Something that you basically have to follow the rules, otherwise you get beaten up, so to speak, and then you learn to follow the rules because it's important. And so in this case, if you are good at following rules, this trend following system will be best. But in the other hand, you can think of it more like turning us into a bit of a robot. But that's precisely what we need to do, because when we do systematic trading, we put it in the software, we come with some result to backtest our trading and so forth. This method, the hardware we use to actually tracking our trade and so forth, doing our backtesting, is a computer. A computer have got no emotion. It's just doing ones and zeros. It just do add and subtract. It just do calculation overall. That's it, on and off. It doesn't have, my wife is having an argument with me. The kids is sick, not going to school. I just lost my job. It doesn't know any of those things. It just say, okay. It basically just think that, okay, this is my method, and this is what I need to plug in as my calculation, and this is my outcome, and that's all you need to do. And so that's how systematic trading is all about. If you are not disciplined a lot of the time, it's not a system that's not working for you, it's you are not working for you because you failed to follow your own system. Okay, so as far as I'm concerned, overall here is Brent crude and oil in general has been quite volatile in a way early in the year, but then later from April, May onwards, it's been quite systematic, slowly moving out. Very boring, but you make money also that way. But long-term system don't seem to be making much money at all from this pandemic. It catch the long-term system catch the downtrend, but the uptrend because people are not really recovering, so to speak, isn't it? I mean the countries, people driving cars or plane in general, or the ships sailing around different countries are not really being used to the max. So the oil is sort of coming down at the moment, which is fair enough to say. It's just that's the nature of the business. So that's going back to reiterate my thinking of my reason having a number of tracking a number of markets. So if oil is not working, Tesla is working. If Tesla is working, copper is working, which I want to talk about next. Okay, the next thing to look at is copper. I don't know how many of you actually trade the copper or even look at the copper map. The chart, it just looks very interesting as far as I'm concerned. In general, for the past 2-3 years or so, when Donald Trump started pressing on with China with the trade war and so forth, the copper chart seems to have slowed down quite a bit and gone sideways and going down, and it's become a little downward triangular flag. But that's the last couple of years, so to speak, just up and down, up and down. And then, of course, coronavirus comes in early in the year and just hurt it quite badly. And just like everybody else, every other stocks or indices or metals, it's gone down quite a bit. And basically, for the first 3 months, it just goes down really, really badly. But then at the end of March, something happened. The war of money, like what they have done to Australian dollar against US dollar and other stock as well, seems to have helped the copper for some reason. And ever since sort of like I think it's in mid-April onwards, and it's recovered somewhat. And the 2 ATR system that I'm using and tracking this commodity and trading it has been up relatively good, and give you a buy signal at the middle of April, and then only stop, so to speak, in about late July, early August, so to speak. And then recently, last month or so, it gone back up again. So this is something that why I want to bring it up is a lot of time when you don't look at what news, so to speak, don't look at certain market, you won't know anything about it. At the time, in March, February, even up until now, everybody's talking about talking about a lot about COVID-19, about the stock market crash so much, so quickly, and the ferocity of that, the speed of that crash, and then the recovery of the last 4 or 5 months, so to speak. And only recently, from the last month or so, I start hearing people talking about copper. But copper has been recovering, just a lot of commodities since April, as far as I'm concerned. But nobody actually looking into it until recently, when it had make a sort of like a new high for the last 12 months or so. And so this and nothing go back to the previous one about the news. The news, any news channel, financial channel, they just basically sell you some sort of latest views of people or the traders or the market is thinking. But a lot of time they don't know everything, and there's a lot of other things that they don't report on, or they don't want to report on because it's not interesting. If you compare copper to gold, more people will be interested in gold. But that doesn't mean that copper is not something that you shouldn't trade. It's just that it's not on the front line, so to speak. But if you have a proper portfolio management and proper portfolio selection, and you include copper, you have make some money out of copper as well. But you also think, with COVID-19 happening, with the trade war between US and China happening, and economy around the world more or less slowed down, how the hell copper price increases? And it's basically, it just shows the strength of the US dollars really weakening, because that 2 trillion US dollars are basically hit the market around the world, and it's just causing a lot of inflation in my view. It just pop up a lot of metals as well as shares in the moment. So the point here for the copper thing is, if you have proper management of portfolio selection and so forth, and if one place are not making money, one of the share or selection that you do, let's say Apple or Tesla at the time, or Amazon or Google in this case is quite volatile lately. There are others that you can use to make money, and a lot of times you don't even need to. A lot of time those one that you actually making you loads of money are the one that not even talked about, and on the main news, so to speak. So, in going back to my portfolio management kind of things, I was think for all of us who really into trend following, it's better to trade a number of markets. I mean, initially probably maybe five, just to or maybe even three or something, just something that you can keep tab on. But as you grow in your trend following journey, so to speak, and career, you should start to expand a bit more to go into commodities and other things, and index and for foreign exchange, so to speak. Just basically your broad view or track of the market. So if one market is down, let's say for example oil is down, the gold is up. When oil is down, copper is up, so to speak. That kind of things. So at least you get more balanced kind of things here. And the other main point here is news. Financial news only just tells you the things that general market want you to. The company, the news company want you to know about, and it's not really something that maybe the latest the hot thing that actually make you money. A lot of times you can make money with something that's very quiet. Somebody not many people covering it. Like I said before, there's always a bull market somewhere, and also there's always a bear market somewhere, and it's unfortunately there's no way you can catch everything unless you have loads of computers and just basically have one computer track each market and or a number of markets and do all this stuff for around the world. Then yes, some big company does that, but for retail investor, I think it's best to this copper trade basically shows how good it is to have a proper portfolio selection, so to speak. And again, this one, it's fairly quiet. Only reason is people are talking about it, and financially just give you a feeling that maybe time to about the top, kind of thing. But with the strength of US dollars continue to weaken, there might be some life yet in here. But on this one, if you are like me, have to at least have a minimum one contract or basically one trade on copper, you have make quite a bit of money on its own again. So for me, as far as I'm concerned, yes, unfortunate the coronavirus have hurt us a lot, especially our jobs, so to speak. But if you have proper trading system, like a trend following system, you can basically benefit from the ups and downs of the market. And the other thing I want to talk about here is you really need to make yourself comfortable trading both sides. That is, shorting shares when they're down and buying shares when they're up. Same thing for commodities, same thing for metals and so to speak, or the other trades. Because at the end of the day, you shouldn't be scared of trading downside, so to speak. Okay, so let's say Apple going down, and it's called you go down, short it. Okay, in US or other country might not allow you to do shorting shares, or your local brokers say it's very dangerous. But there's other options like using options or other means, CFDs, and I use spread betting quite a lot, and also CFDs, and you can benefit from it. That's the main thing for you to take away from this one on the copper trade is that it can you need to make sure that you can comfortable to take in both short trades as well as buy trade. Okay, so you can basically benefit when the stock is going down or the stock is going up using the same system. The only thing is just reverse the price. That's all. And 55 the total system 2, 55 days breakout. It applies to both. 55 days high or 55 days lows. So that is a good example to show you how to handle both ups and down markets. And for me anyway, if you only look at the bull market, the up market side, you basically have your profit potential, so to speak. Yes, a lot of people feel more comfortable, maybe just the local rules, financial rules and services only give you the choice to only buy shares when actually moving up, so to speak. Fair enough, but just like the sun and the moon, sun goes up, moon also goes up too. When the sun goes down, moon goes up. So to only just always trade on the sunny side, on the bull side, as far as I'm concerned, is you limited your the potential in earning more money, and so I think it's something that's worth to look at. Okay, the next thing I want to talk about is the Nasdaq. Nasdaq seems to have benefited a lot, held a lot from people working from home and people logging online, doing their work, watching TV, Netflix, buying computers and buying grocery online, so to speak. So a lot of online technology companies gone up, similar to like the vaccine company and so forth. Um, but on Nasdaq, on this for examples, it have gone relatively strengthened quite a bit. Early in the year, yes, like everybody else, Nasdaq was sort of like not it's making a bit of leeway, so to speak, and up to like February time, and then it just get hurt. The whole index sort of fall down, and down to about 7,000 marks or that area. But then the Fed, this wad of money given by the Fed, the $2 trillion, really pushes it, and because a lot more people are using technologies to work from home or go online to buy things, also to bet, make trading shares and so to speak. The technology basically have moved quite a lot in not just US but I think around the world as well. There's benefit a lot. But what is actually shown here, what I would like you to think of this another system that perhaps you can think of is something I read about a long time ago, and it's definitely useful in this case. If you actually look at, let's say Nasdaq for example, the recent high, basically the high that made just before the COVID-19 sort of touched Europe, and of course it's a big hoo-ha in shares around the world, stock market around the world. After the Fed have pumped in loads of money into the market, we see that this high has been broken, and in this case in Nasdaq, yeah, and then the index continued to just roar further up and up. So the previous high on around February this year is around just under 10,000. It's about 9,500 areas. But now obviously Nasdaq gone to as high as 12,000, that kind of thing. At the moment it's about 11,000 ish, 11,500, about 11,000. So basically, this one thing that you can use is something called 52 weeks high, breakout. So if you got a share or index or cross, that's forex cross or commodity, whatever. If we have made 52 weeks high, so that means it made a new year high for the past 12 months, the highest high, and we have broken it, and the shares stay above that. It's basically a good trend following system to have, and you've seen time and time again for the past 3-4 months or so. You have Tesla, you have Apple, Nasdaq, Square, eBay, Snap, ETS, name it. Quite a lot of them have made 52 weeks high, and you have actually bet on it. Buy those shares or cross or index, whatever, and actually basically say if it's the high is the recent high is the highest for the last 52 weeks, which is the last 12 months last year, and you basically just get on board and buy the share, and the momentum will just help you to move up. And in this case, this wall of money really did its job. So what was something I think all of us need to watch out for? There might be some volatility coming up in October, a month that has always been market crash sort of thing. We might have a lot more of that this year with so many things that's going on, and of course Donald Trump is trying to get re-elected and so forth, and November is coming for the election, so we might face some more volatility. But as far as concerned, this wall of money is actually in the market unless US Fed actually putting money back, sucking money back into the systems, and just like quantitative tightening, what they have done, I think a couple of years ago when the stock market sort of slowed down quite a bit. I think this wall of money will just basically stay in the market and just go around the world. You'll be in Europe, you'll be in Asia. I think ultimately you'll probably go into Asia somewhere, because I believe China will be the best one that actually recover. But this wall of money is not going to go away. It's got to have everything. And if we have if it's expected, let's say there's a high chance, I personally believe there's going to be some sort of reaction or more of a correction, so to speak, a sharper correction in October, just to nullify some of this bull run for the last 4 months or so. have a 1 month volatility, going down. It's nothing in a big major part of thing. But I believe this $2 trillion is definitely going to stay in the market, and it's going to continue to cause a lot of stocks and indices going up higher and higher. So we just basically wait and see. It's just my view, but mainly for me is on this one. I think if you use 52 weeks high breakout is a good system to actually to use at a times like this one. There's just mad money going into the system, and this is quite useful because you don't have to do anything. You just have to remember the price of any shares or indices or commodities going about 52 weeks and just stay there until it's come back down. Let's say come back down 5% or something. You have a trading stop loss or 10%, then you can just get out. But it's a good thing to actually make money out of it that way. But this water money really have to watch out, and it's something that's just probably going to help us to make a bit more money in the coming months. Okay, so this is basically the end of this podcast, this 100 episode, and thank you for listening so far, and please love to have your continued support, and please continue to subscribe and listen to my podcast, and I talk to you next week. Bye for now.